everybody, let me show everybody who's here now some ideas. Let me see. I'm going to mute your microphone. Some ideas about when you get in a trade, what to see. Whoops, no, not ask me. What to see and when to get out. Okay, so like, let me pull up uh, something that's been. Okay, how about this one? All right, this is a semiconductor stock. Semiconductors have been doing good. So for on the daily chart, so if you were going to be doing a swing trade, multiple days, but actually a lot of these rules that I'm about to tell you will work with day trades as well. So when you're in a trade during the day, you want to make sure that when you enter that you've got a good, more than a good setup, that everything's kind of like working in direction. So this wouldn't apply for like Workhorse. That's a good example. It could apply a little bit, but like Workhorse, because it has this USPS contract coming out on news. So Workhorse wasn't trending. It's not really trending. It's chopping and moving around. And if it gets awarded a contract, it's going to just go through the roof, right? It's not even going to go. It's just going to be through the roof. It's going to open gapped up one day or something, you know, or halt and then it's going to open at 110 or something. So those are the kind of stocks a lot of you guys play. I know you do. They're penny stocks usually, you know. You buy something, you know, on a dollar, it's got this crazy news and it's a bam, right? And it just goes through the roof. So these techniques can help you make sure you don't lose money on those spots, but they're designed for you to make money as regular income on any stock, and to make sure you don't lose money. So it's less designed to be working with just erratic news-based blow-ups, and more designed to be used where a stock has been just doing its thing and it's running its business and it's you know, moving along its merry way. In this case, this stock is 250 bucks a share, you know, so probably anybody who wants to play this stock is gonna be buying options, or you could buy like 10 shares. That would work. You know, you would be making some money using the techniques that I'll show you. But my point is that you may want to stick to stocks that are real stocks for making income with swing trading and day trading, really. So when I say what I mean by real stocks are stocks that are above 17, but I mean, like, I'm really hoping for $60, $80, that range of stocks, you know, or Facebook, $160. Apple now is $107, $115 now. So just kind of like, you know, you'd almost say good stocks. But you could apply this stuff in the reverse to really crappy stocks, I suppose. So the first thing you want to make sure is that your entry is near the 20 moving average, and if you're going long, buying calls, trying to make money going up, that the angle of the 20 period moving average is upward, or it's just started to curve upward, okay? Or a gigantic green candle just went through it, which is, you know, 95% likely, like this one, to change the curve into upward, because it just like, it has that power. You know, a big candle can just like reverse things. I noticed that on Eno. Let's go back to that for a second. In the reverse, you can see in just one powerful red candle right here, it went from up to doop doop, now it's down. So don't take trades that go long by calls that make money, that are intended to make money, that go up, unless the 20 period moving average on any time frame is going up as well. And it could be just a little bit. It can be the beginning of that move, like this one. Started to curve it up, boom, it's curving up, now it's going up. So make sure you're confirming long entry there. You don't want to be getting into something like, somebody might say, hey, is this a good time to get into, let's pull up Workhorse. That might be a good example. Actually, this one might be a good example too, but I want to show bad stocks. No, Workhorse is not the greatest example. We'll go back to that later because this looks like a pretty hot example, actually, a pretty good example. What about NIO? Let me pull that up. But also this one, ENO might work too. ENO and NIO. Yeah, this sort of a good one, but I'm going to go back to ENO. Okay, so you might hear some traders tell you, oh, there's going to be support here because look, it goes ding, ding, ding. So there's obviously some kind of resistance here, which came into play multiple times. And then there's maybe support here and support here. And so some traders might say, okay, there's support here. We've got a lot of support here. So maybe we should go in like right around here to go long because maybe this thing's going to turn around on us. You shouldn't be that kind of a trader, which is like, let's get in this before it's going in the direction that we want it to go. You'll make more money and lose fewer times if when you get in, it's already basically going in the direction that you want it to be going. So, some people might buy down here, which turned out to be good. 5 days later, it rallied. Hopefully you'd be able to get out. But, you might have thought that this might have been a good base or whatnot. But basically, you don't want to go in long calls to make money going up if this slope is going downward. Let me let in Sean. He's asking to come in. I don't know why we had to. Hey, Sean, welcome. So you don't want to enter when to go long or buy calls when this slope is going down. So that's number one. You want to qualify your trades, and here it was okay to go in. So depending on who's giving the alert, what the alert is, based on what the setup is with the technical resistance and all these different things that a particular trader may be alerting you to, or if you're finding your own trades, just double check that if you're going to go long, that you're not in a situation which it would be really difficult for this 20 period moving average to start going up. And ideally it should already be going up. Like if we go back to M Power, you can see that slope is pretty much always going up for that period of time. It was, right? And now you don't want to be in these trades anymore. It started to go flat. And so you really don't want those trades when it's like flat like that. You want to get in when it's going up. This is the daily chart, but I'll show you some minute charts too and how this works in day trading as well. But number one part of not losing money is making sure you're getting in when the momentum is there or it's just kicked in, right? So, and you know that slope's going to go up. So many traders are watching that slope, so it's auto-confirming too. It creates a feedback loop. So in this case, one method of entries that you could have gone on here is you could have entered anytime there was a breakout of a candle that dipped into the 20 period moving average. So we have here, this candle dipped into the 20 period, but then it never got broken out, see? But this next candle dipped in, and dipped in even further, but it did get broken out. So you would enter at that breakout point, or there might have been a different reason. Maybe there was news that day, whatever it is. I just want to make sure that I follow a trade now. It doesn't matter how you got in. you should hopefully have gotten in for good reasons, and someone gave you a good setup, and you're in, or you found it yourself and you're in. So now let's say we're in this trade right here, and we got in on the breakout of that previous candle with the big long green candle. So it goes up, and then it starts to go in the opposite direction, right? The first thing you want to do once you're in, and this is on the daily or in day trading, is you want to set your either mental stop loss, or if you have time to type it in and put in a stop loss order, you're going to have to put in a bracket order with multiple profit targets if you do that. But if you're in a mental stop loss, you want your stop loss to be at the bottom of the previous bar. See this red one? So right there. And you could alternatively, it's really up to you, based on the strength of what's going to be going on, you could choose to put it at the bottom of the bar you entered on, which you entered like right at the top there on the breakout of that price. So now if the stock goes against you, you're not going to lose more than that one bar. And that's really important, because if it does go against you, the thing is, this is all about risk reward. So when things go your way, you're going to tend to make 2, 3, 4 lengths of that bar in profits. Sometimes 5, 7, 10, 20 lengths, in profit. And in order for you to stay above the profitable point, you cannot lose more than you're going to on average be making. So, and you can really amplify that ratio of win amount in dollars to lose amount in dollars by not winning more, but by losing less. And so if you just get stopped out at the bottom of a particular bar, it only means that in that particular instance, you didn't pick a moment where the momentum continued, and that isn't always your fault. That can be just a normal part of trading. But it also, you should be honest with yourself, it also could be your fault, or the person who alerted you's fault. In general, there can be moments that weren't right for entry. And so you don't want to be still in the trade when it's gone against the momentum bar that you got in on, which you should almost always be getting on a breakout inside a momentum bar like that. That almost should always kind of like be your entry, because it confirms the momentum, and now you can grab some, and then either yes or no. It either does it or it doesn't, and if it doesn't, get out. Where? At the bottom of that either entry bar or the bar that you were basing the breakout over the top of. It's low. So either one of those lows. Okay? And that's going to prevent you from losing money a lot. A lot of us have frequently held on or missed that out and thought, oh, maybe if I just wait a second, it'll go up a little bit more. And then, ooh, now it's going up a little more. Maybe I should hold on. And then it reverses the hell out of you, and it's even lower than when you made your mistake of not getting out and you were waiting for it to go up a little bit, and now it's even lower. So you have to get out at the bottom of that bar. You just have to do it, because if you start making those exceptions, it's going to mess your ratio up of your win to loss, because you need to be able to lose a lot. Hey, Sil, did you want to say something? Your mic came on or something.
Hey, Evan.
Yeah.
I really liked this kind of topic of. I think this is one of the problems I'm having the most. Is like I'll feel really good in conviction of my view, and it's like I will admit I have a hard time with the stop loss.
Yes.
Eventually my trade will shake out, and the trade will have made money, but yeah, I get stopped out. Like just like you said, like I'm like, oh, I'll give it a little more room, and then like it crashes down, and
I
then I'm like,
know.
and
Yeah.
then I emotionally get defeated, so I don't even want to get back in, and then like eventually it goes my way.
And it goes your way, and then you're like, I wish I got it in, so you get in, and then when you're in, it goes against you again.
Yeah, yeah,
Aurelia knows what I'm talking about. So, so yeah, so this is just the beginning of like, I mean, you should take some notes now, maybe on a paper, anybody who wishes to. But you can watch this again later. I'll put this link up, for you guys to rewatch this class. But we're gonna go with like, I'm gonna give you a lot of ideas on how to get the hell out of a trade. But number one, if it's a swing trade, that means multiple days. It could be just overnight, but that's one day, one or more days, and it could be weeks with swing trades, whatever. Uh, with swing trades, you're talking about the daily candles, and so the bar you enter on, either the previous bar that caused the trigger of entry because it broke over the top, you use its low, or the bar you entered on, if there was like a lot of momentum and the next bar was super green, you're like, oh, yeah, I can easily just move that up from that red bar to the bottom of the green bar that I entered on. So at the minimum, start there, and that's just gonna set you up for losing, for having smaller losses. And if it's a system like that, if you always do that, if you get it to the point where you're always doing that, then it becomes actually part of your profit making system, which means that even theoretically, technically, even when you lose money, you didn't lose money. You didn't lose money because you already know that's part of the system. You only lose money if you fuck up that bottom of that point and you get out, you don't get out. When you don't get out at the bottom of the candle, now you're losing money. But the actual money that you lost from your entry to the bottom of that candle where you got stopped out, since it's part of the system that makes money, it actually didn't lose money altogether. When you combine all your trades, if you do 20 trades, you're going to win 12 of them and lose 8. But overall, it's all going to be profitable. And so that means that's part of the profit process, stopping out properly. So, oh, somebody else is trying to come in. Let him in. All right. I have to put like mute people on entry. Oh, I did. Okay. Uh, so, so that is something that you really need to maybe write down or get into your head, is that if you have a profitable system which says, hey, whenever I'm losing money, I don't lose more than that one bar. And whenever I make money, I'm averaging like 5 bars of money that I'm making, 5 bars worth of what I would have lost of money that I'm making, because sometimes you win 10, 15 bars, sometimes you win 2, 1, and sometimes you lose, right? But overall, it might be like 3, 4, 5. So you're not actually losing money when you stop out. That's the amazing thing. You're just saving the money that for the next entry. All right, so start to love stopping out. That's going to be number one. Um, and try not to get into setups. This is another one. Try not to get into setups which allow for too much room, which allow for too much loss. Just go ahead and get out if it goes below that candle. And if it goes back up, for example, if it goes back up and you're like, damn, I got out, and it goes back up, if it's that next bar and it breaks the candle you got in on and it breaks up, just get right back in, because that's a sign that the price is just continuing in the same direction. And you wouldn't, so maybe you lost there and now you're back in, but you're back in and you'll have like less regrets and remorse and stuff. And you're back in, and maybe you get to participate in an amazing move. And sometimes that's the way trading is. In fact, that is the way trading is. Sometimes it goes against you, and the only way for you to win is for you to get out in those spots. And sometimes those spots are like, it's like a boxing match. It's like when you jab or when you defend, and it's like those are the spots where you defend. and or just do like a little jab, you know, and and you lose, you get hit, but you're waiting for the knockout, you know, and so you got to keep staying in the game. You can't boom boom and just keep getting hit and then just leave the ring. You have to stay in there, keep it tight, stay with the opponent, and take little jabs, little hits. It's okay. Oops, you can get 7 of those losses in a row because maybe an area is very choppy, and you go in and it's like, oh, I got out, and then you go in, oh, I got out, and you go in and oh, I got out. Maybe that's the way the day is. Today was like that, but tomorrow, who knows? Tomorrow might be a beautiful day filled with green everywhere, and it's just running, right? Or red if you're going to play short. And that happens. Those days come. They come just as much as there's choppy days. Uh, and when you get in those, you're going to put your money in, and it's going to start running, and you're going to be like, whoa, and you're going to make 7 bars back in your first trade. And then that day, you're going to get in like 4 more times if it's a day trading thing. You're going to get in like 4 more times. You're going to make 5 on one and 10 on another and 3 on another. And you're going to be way beyond, but you'll think you're a loser, but don't think you're a loser. But you're going to think you're a loser on that day where you lost 7 trades in a row. But you know you're not losing money if it's part of the profit process that you get out at the bottom of those bars, because you know that those bars equal also the number of bars that you make money on. And if you ever make them bigger, it fucks with the math, and you're ruining your ratios, and you won't be making money. So, all right, that's a big long lecture on getting out at the bottom of your entry bar or the bar before it. Okay, but I'm also saying try not to get into setups which allow you to gamble, like that the thing hasn't happened yet. Don't do those. Just like write that down somewhere. Stop getting into things where nothing's happening yet because something's supposed to happen. Wait for it to happen and then get in, because you making a little bit of money on certainty is going to make you so much more money in the long run, even though it's a smaller, let's say, amount of the move, than you speculating on 45 stocks in a row that were supposed to go up and pop on something, and they don't pop, and they keep breaking down on you, and you're losing money. So don't get into setups or gambles or plays that people recommend or that you think of that that aren't getting you in when things are already happening. Because I'm going to show you like a mini method. I can give you many methods about entering trades when things are happening, and they work really well. In fact, hopefully if you get a chance, you can watch last Thursday's class where I laid that out for like an hour and a half, how to day trade. Kind of like what I was just showing you, a similar system where a green bar breaks out over a little red bar. So, but now I want to continue to give you some ideas about how to increase your stop loss up as a trade goes in your direction. So let's say here we have this red candle pull back to the 20. By the way, just for clarity's sake, this is, I believe, I better zoom out to be 100% sure. Yeah, that is the 200 moving average, this one. And this is the 20 moving average. And those are really good because they kind of give you the short-term bounds and the very long-term bounds of what's going on. So like for instance, in this stock, you can see the stock is just trending. In long-term sense, it's trending up because that blue line is just going up. In the short-term sense, it was trending up, but in the short term, it took a little bit of a hit. Didn't affect the long-term trend though at all. So in that sense, it's still ripe for entry. And as you can see here, there was a red bar underneath the 20 period moving average, which had a green bar break out with momentum. And that's almost enough clue for you This is like level 2 or level 3 of this kind of teaching, but it's almost enough clue for you to get in right there, because you would know that if the next candle is green as well, which it kind of ought to be based on what you just saw, that's a lot of momentum, that this yellow 20 period moving average line is going to curve up. And it did so, and you can see you get a nice move out of that, and it's going to keep going. As a matter of fact, I think probably tomorrow that's going to go up more. So my point there is, that's how I trade. I use the 20 period moving average and the 200 period moving average. And I look for those pullback moments that pull back into the line there. And when something's trending, I enter on the breakout of the bar, on the momentum breakout, which should be like a big green candle, or it doesn't have to be big. It doesn't always have to be big. Or like, look at this one. Where was that one? Yeah, so, all right, but let's go back to managing trades that you got into and making sure you don't lose money. So here's another thing. So you get in here on this one. Let's say this red bar, it pulled back to the 20 period, and the green bar next was a momentum bar. So, and it broke out of the top of that red, and we're in an uptrend, so that's awesome. So we've been waiting for this moment. So we enter. You enter exactly at the top of that red candle, but on the green candle. Hopefully everybody understands that. That's a breakout of the red bar. On the green bar when it was happening. In live time, like you're taking it right there. The candle is green, and it will be green. It may be red for the beginning of the days, it's falling down there, but then it turns green, and you're hoping it's going to break that high, and so you enter. Okay. Now you're in, or you're in for another reason, because I'm trying to show you some other ways to set stop losses. And then you're in, and your stop loss should be the bottom of that bar or the bottom of the previous bar, either one. And now the trade is moving, and it didn't get stopped out there, but here's what's cool. Whenever there's and I was teaching this to Aurelia earlier, whenever there's a red bar during your position, after there's been 2 green bars, raise your stop loss to the bottom of the red bar that was there. So now we're up to here. So now you should be getting out of your trade if the stock were to ever fall down to that bottom of that red bar price. So then we have another red bar here, another red bar, and then 2 green bars. So now we would set the stop right here. Okay. And I think at this price level, 235 bucks, maybe you guys aren't trading stock, you're trading options. So your entries and your exits are going to be on the option, but you're basing that on the stock price candles, like I'm showing you now. So you can just, for the stop loss, you probably want to sell at market or limit minus 10 cents on your option. And then when you're buying, market or limit plus 10 on your option at the mid on both cases if possible. But if it's a fast moving situation, you can just get out at market. A little sloppiness is going to be all right, but with options, just make sure you've got good liquidity. All right, so look, it raised the stop loss to there. And then here we got a red candle, and we had this like starting to get the pullback. Now see, when this red candle here went below the low of the previous other red candle, that can be an indication to you that you should get out. And you would have did that like right around here. You would have like got all out, or you could get half out. It depends on how many contracts you have or how many shares you have. You get like half out, but like substantially out, get half out and or all out right there. And that was good. You got a move from here to there. So that was 227.50 to 245.80. So what is that? 245.80 minus 2, what did I say? 27.50? I think so. That's 18.3 points. Now, if that was an option and you had like, say, 75 delta, you just made like 1,500 bucks on one option contract. So per option contract, if you bought like 3, which you might want to do 3 or 4, then you could scale out, you know, and do like what I just said. You could take off half your contract, so you'd sell 2 if you had 4. Obviously, you know what half is, but you know, just trying to give you kind of like a simulation of what this would be like. So now you're still holding 2, and as you can see, the price really pulled back and then rallied again, and then it kept rallying. So I don't know, but this is kind of a choppy region. So I have a feeling that all of the rules that I just gave you would have probably fully stopped you out, and that would have been okay, and for good reason, and you would have made thousands. All right. Now, here's another money management concept that I really, really want you guys to adhere to, and that is that if you have a small account, medium account, big account, whatever that is, you should not be getting into positions that are larger than a certain percentage of your entire account. So let's say your account is, I'm going to give an example of like $1,000, and then $10,000, and then $30,000, $25,000. Okay, so those are small, medium, and big, and that's pretty realistic. And because like after that, you know, you've got pattern day trading on, and you just make money forever when you have got pattern day trading on. It's so good. But so on a small account, it's going to be all right if you get positions up to 10% of your total account value. So if that was $1,000 account, $100 per position. Sometimes option contracts can be like $180, $130, depending on what you're looking at. So, you know, you can fudge that a little bit, but don't fudge it too much, because you're potentially going to lose more money than is proportional to your account and how much money you can muster to lose. So 10% would be the maximum for a small account. For a medium-sized account, so I'm talking maybe $22,000, $3,000, all the way up to like 15,000. Yeah, somewhere in there. 5% should be your max position size. You should never be exposing yourself to any one position more than 5% of your account size. Obviously, this doesn't exactly apply to day trading, but this applies to holding positions for more than one day. And then for large accounts, so 5% of like $10,000 would be $500. So now you could start to get into $500, $300 options, or you could get a $110 option like 4 or 5 times. So you can buy 5 contracts. This is like a crucial, like I can't, I don't want to play this down too much. This is more crucial almost than the stop loss situation, although they do work hand in hand. You have to be profitable, and you can't be profitable without a profitable stop loss and take profit system. And that couple of systems that I just showed you will get you there. But the other side of this is money management, your account management. Yeah, John.
When you say the 5%, 10%, you're talking about value at risk. So like how much
No.
like where you would put your stop loss, or you're talking like notional, like don't bet more than 10% of on
Yeah,
one
like
trade.
fully, like not value at risk, like fully, not like, okay, I'm going to stop this out, and so therefore I can get 4,000 contracts because I'm going to only lose $10 a contract, etc. No, you can't do that.
Fair enough.
If it's for more than one day, if you're getting any kind of like positions that are going to sit there and can be toxic to your portfolio, you want to make sure that it's also to make sure that you just diversify your bets. So it's also because of that. It's to prevent you from getting overly from not betting diversified enough. Because if you have let's say an odds going on where you're going to lose 7 trades but you're going to win 13, and you're only taking 1 bet every 3 days, it's going to take you almost half a year for you to actually break even on those odds. theoretically 13 to 7. You know what I'm saying? You're going to lose 7, you're going to make 13, you're in each one for a couple days. It's going to take, you know, like 50, 70 trading days for you to see one statistical sample of 20 trades run its course. Whereas if you sized your positions to be 1/10 of your portfolio or less, if you have a larger portfolio account, then it allows you to be in enough other things that you can start to get a return on the odds much faster. And that's really how you want to do things. Not necessarily for day trading, but I'm talking about for holding swing trades or having positions in your portfolio. Yeah, for day trades, you better be a profitable trader first, though, because like day trading, yeah, you want to be a profitable trader first before you start risking half your account on a trade, which you should do when you are a profitable day trader, or even all of your account on one trade, because you know how to stop out and get out instantly at whatever. You know, you're not doing these penny stock things that are going to halt and destroy you. You're doing these kinds of things, which I just showed you, day trading, but on reliable trends, which is really the income way of trading. You know, instead of like, you know, the get rich quick way of trading. Believe me, you're going to make money every day if you do these systems that I mentioned. You don't have to, and that's sexy. You know, you don't have to be getting. It'll get you rich quick enough. You know, you can make, like, if you have a $25,000 account. Well, you can pretty much make three. Doesn't matter how much the account is, but you need a pattern day trader if you want to make an income per day, like day trading. You need a pattern day trader because you're going to be making 50 or 100 trades, like 7 trades, but you're going to be re-entering, building, accumulating, taking profits a little bit, you know, off, and then this and that. And so it might be like 17, 15 trades just for one trade, you see, ins and outs. So my point there is that you need pattern day trader, but here's what I was going to tell you, is that if you have a pattern day trader account and you do income day trading, which with winning profitable strategies, on like trending stocks, which is the easiest way, you should make about almost like between 1% and 3% per day. So that would be like $250 to $750 per day. So if you have a $25,000 account, you could be making like $2,500 a week to $7,500. I don't know, maybe I didn't do that math right. $1,200 a week to $3,500 a week with a $25,000 account doing pattern day trading with winning day trading strategy. You can check out my winning day trading strategy on Thursday night. I posted that class. Some of you probably saw it. But yeah, so you got to couple the risks that you're taking with proper account and portfolio position sizing. And that's not necessarily to hold you back from making money on something. It's, like I said, to get you more fully diversified in your bets so you actually see the damn return faster. Because if you're in 10 things or even 20 things, because if you have a $25,000 portfolio or more, you should be sizing at around 2% to 5% max. And even 1%, and it really is not a big deal if you even do 0.5%, so you can get 50 positions going. Well, I don't know if that's the right math, but yeah, 200 positions. Yeah, I don't know what I was about to say right there, but that's very important to make sure that, oh yeah, so that way you get the return on your odds back. Yeah, because it's good. Your odds are never just 2 to 1. I mean, there's no system that goes 2 to 1. It's always, you know, you're going to need to make 20 trades. Things go in lumps of 20 trades before you really could reliably say, oh, okay, you know, yeah, I won the majority of the time. Or actually, with like 20 trades, if you had a 4 to 1 win-loss ratio because you stop out real quick and you let them run when you're making money, you could actually only need to win 5 of those trades and lose 15 to break even. That's pretty cool. But with the right strategies, you can be winning 9, 10, 11, 12, 13 times out of 20. And so with a 4-to-1 win rate, that means 4 times like 10 would be 40, and then say 10 losses would be 10 to 1 at 1 ratio would be 10. So 40-to-1. So you won $40, you lost 10, or you won $4,000, you lost 1,000. So you're getting ahead. But you can't see that. You can't feel that and experience that if you're doing one trade every 2 or 3 days. In fact, you might lose 7 times in a row, and diversifying your bets will actually like kind of keep you afloat better, because these ones might go down and you have to stop out of them all, and so you lost like $700 because you lost 100 on each. But then simultaneously on the same days or whatever, these other ones went up, and so you're cushioned by the odds better. So long as you've chosen a profitable strategy, then getting into more of those bets will allow you to see the proper odds sooner. I used to be a professional poker player, so that's why that is very at the top of my mind, or whatever. Oh, somebody else is trying to come in. It says Zoom user. It's not supposed to allow anonymous users. Let's see if this is a troll. All right, think of a question, guys, and I'll show you some more.
In terms of, so Evan, I know you've talked like in terms of like small, medium, large, and stuff like that. I think one of the things I'm struggling with is like, from a money management perspective, what approach do you take? Like I have like kind of like long-term, larger, like retirement type savings, and then I'm trying to create like more of like a day trading portfolio, swing trading portfolio, but it's really hard for me to like filter one versus the other, particularly right now that like the market is kind of choppy, and it's not like you're gonna just blindly put it in mutual funds or something.
Dude, I have the same exact problem. I have a Roth, I have a rollover, I have a individual, I have a trader account. I have several trader accounts, and and depending, some of them will balloon and other ones will shrink. You can't control that, and so then I have to wait. Just because some of them are linked all in messed up ways, sometimes I have to wait a week to get my day trading account back up to above 25K, because maybe it got hit and it's at like 23,000, and my Roth or my other accounts are really big, or I have a bunch of accounts like that, and I need to transfer the money, and so I totally hear you, man. It's a pain in the ass, and so then I end up I start day trading from my Roth, which is like a real pain in the ass, because I might have a lot of available funds, but I don't have day trading, because you can't really, you can day trade, but you don't have margin really. You have something called limited margin in a Roth. So then I can only use settled cash. And so then I can only make a limited amount of trades per day, because I'm eating up the settled cash. So, the real way out of that is to really just work towards the goal of having a $25,000 day trading account set up. But you said you were swing trades, so I'm not sure if that fully applied. But, and by the way, to everyone, you can get a day trading account for less than 25,000. You just have to risk sending your money and opening up an account into an offshore account. And there is one that's pretty reputable. It's been around for many, many years, but there has also been another one, I think in the same island, where the reputable one is, which just disappeared on people, So your money could be at risk, but maybe you could send like $2,500 over to it. It's called CMEG, CMEG. And so, with CMEG, there's probably millions of people who have accounts over there at this point, and it seems to be holding, strong. So, but your money could be at risk, it being offshore, but they don't have to adhere to the SEC guidelines since they're offshore, and so, that's one option for you to practice day trading. You can put like $1,000 over there. I think the minimum is 2,000, but you could look it up on their website. Were you going to say something, John?
No, that's helpful. I was thinking, so being that you're in kind of like the similar setup, like how do you decide what you're gonna put in? Like do you say, okay, I'm gonna do the more kind of swing, longer term swing, and put that in the Roth, and then do more of the speculative stuff in just your PDT account? Is that kind of how you work it?
Yeah, totally. I mean, doesn't that sound logical? That's what I do. And
Yeah,
it just sounds logical, right? So, yeah, that's what I do. But my Roth portfolios, in addition to the swing trades, which are usually on the equity portion of it, it's also a fully balanced uh, all-weather portfolio. So it has bonds and it has gold and it's got commodities and real estate and foreign equities and foreign bonds and emerging market bonds, and it's got tons of different assets in there, mergers and acquisitions, and so I keep that a little bit more balanced and like retirement oriented. But if you have an equity portion, the reason you have an equity portion to a balanced portfolio is because it gives it a bit of fuel, a bit of juice, a
yeah,
little bit over and above what the bonds and all the other stuff give you. And so my take on that is, why not swing trade those equities? I mean, you're in the equities anyway. Why not, buy high, I mean, sell high, buy low, and just keep it on repeat and do like this trend trading and like, so I swing trade equities with the equity percentage portion of the pie of my all-weather crash-proof um, retirement portfolio. But I'll find myself going in there and going like, damn, I have no more buying power today, because it's just the way situations. It's just going to happen. That's never going to end for you. No matter how many accounts you have, something's going to go down, up, down. You're going to need to take money out. I'm going to talk about that in a minute. Um, and so then all of a sudden you find yourself, doing a scalp trade in your in your retirement account, like or you're doing a penny stock, trade in your retirement account. It's pretty funny. But it happens. It absolutely happens.
yeah. That's been the challenge. I mean, one of the things, my main goals in just joining the group and learning more about this stuff is just,
It's
yeah,
going to be so important for you to have at least these couple things: the money management, you're making sure you diversify your bets and don't overly allocate them,
yeah.
and then making sure you get out with some kind of a systemized out that you absolutely adhere to. That's going to be really huge and key. Now, once you're profitable, I want to talk about that. Once a person is profitable, uh, what a lot of traders do, but you could modify this to be weekly, is you uh, write down what the beginning balance of your accounts in aggregate, or however you want it. If you have one, whatever. If you have many, it could be aggregate or whichever ones you would ever withdraw from. You write down that the totals of those different accounts at the beginning of the month. October 1st is coming, so you could practice this. And then by the end of the month, if you're up from that, you may withdraw 50% of whatever you're up, and that's your income. And you can do that weekly. You could do that either weekly or monthly, or bi-weekly, or tri-weekly. But so that could be the way that you can turn your trading profession. And at that point it's profession, and you're making income with trading. Like I said, with a $25,000 account, you should be able to make about $10,000 a month, and then you would withdraw $5,000. So you kind of like have an income, a personal income of like $5,000 a month with a $25,000 account. Because you make approximately like 2% a day. So what is that? It's compounding. So, but in any event, I think I have those numbers right. I've ran those numbers before. So a $25,000 account will give you about $10,000 a month if you have pattern day trading. You have the ability to pattern day trade. If you had that ability with like a $10,000 account, then it would be a similar ratio. So I don't know what that was. 10,000 of 25,000 is like a third. Uh, let me see. Where's my calculator? There it is. 40%. Okay. So therefore, a $10,000 account would earn $4,000 in profits a month, or $2,000 of income. So $10,000 would earn $2,000 of income or $4,000 of profit. Obviously, that's way more than like buy and hold, screw buy and hold. trading, trading like, and then with options, it's just, that's icing on the cake. By the way, trading options is in that method for income is a little bit harder than it sounds, because it sounds easy, but that's because of the slippage, the spread, and the liquidity, and the time it takes for you to find the right strike and input it in and go. You know what I mean? Like this, you have to be really, really good, excellent trader, because you have to see the opportunities coming and get your order all ready to go. And then when it doesn't happen, but another one you're watching is about to happen, like you got to be ready to go over there, and it's like it's quite a bit of work when you're doing that. So the numbers that I gave you, they were based on day trading the stock itself, which you can absolutely do. And that's probably best for another session, but you can make that much money, which I was just telling you, by day trading stock, good stocks from $50 to $250 in that range, that are good companies like Netflix, but not Netflix anymore because it's so expensive. Facebook, companies like that are like strong, trending growth companies. You can day trade the shares of those, of the stock, as opposed to the option, and make that money that I was just telling you, 1 to 3% per day. Because you're entering, you could just watch that stock all day, whatever it is. Because as I explained in Thursday's class, there's many, many entries that come up. We were looking at Etsy. I just pulled it up. One of the persons was talking about Etsy, so we pulled it up, and we just started to illustrate like where your entries and exit would be. And I think there was like 5 to 7 trades, and you're making like a couple $100, $300 to $700, $500, 200, 3, 4 per trade. So some days you can do quite good. You could be making like $1,500, $2,000 that one day. And another day it might be the market's consolidating and things are choppy, like they were today, and you can't even make money. You keep going into things and you lose $60 and you lose $100 and you lose $40 and you lose $7. But you're waiting for the good days. So if you did have a smaller amount, you could become an income day trader by opening like an offshore account. I'm definitely not a person that can, over this thing, recommend that. I can only say that's the information that's out there, and you can make your own decision. I 100% don't want to be liable for anything there. But it seems to be reliable. This CMEG company has been, a lot of people use them. I mean, worldwide. Not everybody lives in the United States. So they have a lot of accounts. And I hear that they have good order execution times, which you need. All right, Sil says, would you be able to show what a breakout looks like on the chart again? I think I just missed it. I'll show that again, because everyone could probably have that in review again. So let's zoom up real much bigger. Not that big, because now they became fatter than they became long. Okay, all right, there we go. All right, this is a great, not perfect example, but pretty good. All right, so on this red candle here, it pulled back to the 20-period moving average line, and the moving average line is trending up. So that means we're interested in making money on this stock going long, going up using calls or buying the stock. And so when you have kind of a smallish candle like that, which is the strategy I talked about on Thursday, and it pulls back to the line, if the next candle, it breaks out of the top price of that candle, which is at the top of the wick of the candle. They call them candlesticks because it's kind of like candles with wicks. If the price of the next bar breaks out of the top of price of the red bar, then you enter right away. And as it turned out, because this is a daily chart, not a minute chart, overnight, I guess the price went up a little bit overnight, and it even opened higher than that price. So you would have missed, you know, some of the distance there. But that's okay. You want to enter when you have confirmation, not enter hoping and guessing. That's not good. Okay, so anyway, this is probably not the perfect example, but you would have entered like right away at the opening of bell, because that's where this candle opened was higher than the high of that previous bar. And all day long, you would have experienced great gains. And you could even get out at that point, but if it was a swing trade like this is, you would not get out yet, because really your stop loss, which is not necessarily your profit target, but you can almost use it as a profit target, because if you keep raising your stop loss, eventually the price goes back down and you take and you get all out, and the difference between your entry and the stop loss is now way up high, and so therefore you made profit even though you got stopped out, because the stop loss then in that situation becomes a profitable stop loss. So, but there are methods that I mentioned in the Thursday class for taking profits along the way as well. But in this trade, you would not have been stopped out yet, which you would have set to the bottom of the entry candle if it was a good strong upward move, or the bottom of the red candle where that triggered the whole scenario of you getting in, which was this one, and then it created that trigger price and you got in. So now the stop loss would be below the low of that trigger candle, or the low of the entry candle. And a little bit of judgment goes in that. It's all about the momentum. If it's a little bit questionable, choose the lowest between the two, okay? So let's go back to one that's like a little bit more obvious, or let me pull up a daily. Let's pull up like, I don't know, Apple on the, not the daily, I'm sorry, the minute chart, intraday. That's more than today. I said today, 1 minute. Okay, there we go. All right. And look at that. Apple went up all the way to 115.5 in after hours after closing at 115. It's a good sign for tomorrow. Looks like I bought a bunch of stuff on the right day. All right, so let's go to where, so let's say all we wanted to do today was go long. I don't know, just for educational purposes, let's say that's the case. But if you're a day trader, you want to be able to go short just as much as you go long. But it depends on the conditions. But in any event, let's say we only wanted to go long today. So as you can see, this yellow line, which is the 20 period moving average on any chart I pull up of any security, it works on anything, is angling downward. And so therefore, that's not a long type of spot to enter. However, right around here, it starts to flatten out. But there wasn't really like a momentum candle, which would have been green, to take. This one is like, it's not breaking the high of a previous candle, which was maybe red or smaller, and now this one's bigger. It's just generally the same, you see? It's not a momentum candle because it's generally the same size. It's like bing, bing, bing. Yeah, it's going up, I know, but the size of them hasn't really changed much. And so that's why the other strategy that I mentioned on Thursday works really well, is because we use the trigger candle we use is a small red bar. But let's try that. So we still haven't got a momentum bar, and then all of a sudden we get these strong red bars. Those are good indications that if like a green bar were to overtake those, that could be entry, like later. Okay, but here's how we can kind of like look at this. So the price goes down here, and now this bar comes up and it overtakes, and it's kind of bullish. It's quite bullish. If you start learning about candlesticks, this bar is much more bullish than say this one, because it went from the bottom. You have to learn about candlesticks to be able to see this so clearly. But a candle is green when the close of that time uh, is higher than the open of the time, okay? But in this case, it started at the bottom and ended at the top. That means it never had any doubts. It's just like a very strong, like for a full minute, it just was pounding, 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 boom, boom, up. So that's strength. That's a lot of strength. So this bar, for me, in my opinion, using like, you know, fuzzy logic, human logic, probably would lead to the curve starting to go up. And I would know that because that's just so strong. I'd be right on the edge of taking a gamble, and if I wanted to wait for confirmation, I could enter on the next candle that breaks the high of that candle. But I probably would have gotten in after it broke this red candle's high, because it broke 2 candles high, or these 3 candles highs. It broke 3 candles highs. Boom, boom, boom. So that is a lot of strength. It's the direction, the momentum has shifted in that bar. You don't have to be perfect at getting that, but that's the breakout still, because you asked, and then you'd be in, you'd entered. So let's say we did enter where I said, because if you enter where you would want to go in, which is like a fully confirmed moment, which is this moment right above this bar here, 113.17, it's not much different than where I would have gone in, which is like 113.14. Okay, so but let's say we got it like right there, 113.14, where I would have entered. Now, the stop loss on that would be the bottom of that bar, or the bottom of like a red bar, or the kind of like the lowest of the group of the bars that it broke, you know? So right around there. But you could choose the bottom of that bar if there was a lot of momentum, and especially since this next bar is so green, at that point you can say, oh yeah, I'm gonna go with the bottom of the green bar here, because it's gone so far now that you can kind of raise it up a little bit, you know? So that's my point there. You don't have to wait for the price to go all the way back down here to go, oh, this sucks, let me get out. You could wait for it to go all the way back down here to go, oh, that sucked, let me get out, because it went way up here. But here's the thing, when it goes here on this red bar, this is that like other rule that I was telling you about how you can raise your stop loss now. Since this red bar happened, if it's followed by 2 green bars, which it was, you can now move your stop up to the bottom of the red bar. So now your stop is all the way up here, which is just about at break even, 113.17. So now you're not going to lose money. You're in a trade. It's kind of like a fun moment. You're like, whew, all right, I'm not going to lose money now, because you could literally now, if you're trading stock, which again, you can make 1 to 3% per day doing this, and that's plenty of money. So you could choose to do that. You know, you might buy 100 shares of this stock, or 250, I think would be the right allocation. I'd have to look at, do the math on that. But you'd buy quite a few shares, and you could type in a limit order, stop limit order for you getting stopped out at 113.17. So that way you could be sure. You're like, all right, I'm not losing money on this. All right. So now, continuing on, that green bar continues and continues, and we have another one of these red bars, and followed by 2 green bars. No, but here's a red bar, green bar, red bar, green bar. When you start to get this where the bars start oscillating like that, and you don't get consecutive green bars, you should start to be like, you know, and you could maybe take a little off the table. You could start to take, let's say you had 100 shares for easy math. You could take, you know, it hasn't fully confirmed anything strong and scary yet. So you could take 10 shares off, see how it feels to keep holding 90 shares through some of these, you know, sketchy areas. And if you can handle it, you know, keep it there, or take off another 10, now you're down to 80. But then check it out, when this candle here, this green one, it was red at one point, and it went below these 2 red ones. To me, that's a very negative sign. Like, The momentum is not holding anymore, okay? Could we be wrong? Yeah. Could it go further? Yeah. Could it really go further? Yeah. Could we get out here? We ought to, because it's guaranteed that you made money and you used a logical system to get out. I would get it all out right here. And in fact, the next bar goes down. So if you did get out and it went right there, on the next bar at least, you would have felt really good about it. But then the next bar, you would have been like, oh man, and it went up, but it was only 3 minutes later that it fell back down even lower than that. And then it did like a little micro rally, and then it fell all the way back down below that. So, and none of those like overcame any little red bars, so there's no further entries going on here, you see. So that was a trade. You entered here at 113.13, and you exited here at 113.64. 113.64 minus 113.17 is 47 cents. You made 47 bucks. Now, had it broke below the bottom of this bar, 112.98 minus 113.17, and then not negative. Actually, our entry was 113.14. That's 16 cents of before it hits your stop loss times 100 shares that you bought in that example. So you would have lost $16. So what was the other one? $48, I think. So 48 divided by 16, that's a 3-to-1 win ratio. However, if you have a $25,000 account, you would probably be buying 250 shares. So instead of $48 there on that little chunk, you would have made like 3 times as much, 2.5 times as much. I'll do the math. 48 times 2.5, 120 bucks. So you see, the first trade is over, and you made 120 bucks. And what's amazing, and you would have lost 2.5 times $16 at most too. So you make 120 bucks, or in worst case scenarios, you lose 2 plus 8, $40. Okay. But what's amazing is that you made that money on when the stock was like basically in the end, it was going in, in the larger scheme of things, it was kind of going down on the day. And you said to yourself, remember we did this at the start of this, we said, hey, I'm only going long. And when actually you would have made money going down as well. So up to this point, you would have made more than $120 because you would have probably had 1, 2, or 2 more trades occur. Or it might have been one big trade. And judging from the size of it, it doesn't look like a $120 win. It looks like you would have probably gotten about a $350 win. So with a $25,000 account, and you're only in 1 hour in the day now, you've already made like 400 or 500 bucks. I know when you play options, you can really like win these astronomical amounts, but this is more consistent, more reliable. I can pick any stock and we can day trade it, short or long, all day, every day, and you can make income. And you can do the same with on the daily chart for swing trading. If you prefer, like maybe you have a day job and you prefer to just check in at lunch and see, if something's broke, or you set up your orders the night before, triggers that, then buy the thing. And if it's a swing trade, maybe you might do options. So buy the thing, if the price breaks, whatever, it's called a conditional order. You can be using these exact same techniques with the 20-period moving average, and to know if you're going long or short on something, to buy puts or calls on a daily chart and be making money on a daily chart. But you're going to do better in day trading or swing trading. You're going to do better whenever the chart is really, really trending. These aren't. Today was a very choppy day. Today's a bad example day of how to make money, and yet we're already making a lot of money in the examples that I'm showing you. But that other one, the daily chart of Empower, like that's the kind of beautiful, let me pull up the daily. That's kind of beautiful chart you want to see. 3 months of 1 day, 1 year, 1 day. See that yellow line? Just it never falters even when the stock falters. That's what you want to see. And those happen during the day in day trading as well. And you get into a trade and you just keep moving your stop loss up, and you keep moving your stop loss up. And with all the right techniques, you actually will be adding to your position. You could get to the point where you have all of your money in the one trade, because it's a day trade. And it could even be, okay, so then it keeps going up and up and up, and you're raising your stop loss, and then boom, you get out, and you make a mega amount of money that day. And you can do that with the stock shares. You don't have to do options day trading to make a lot of money in a day, because of the whole, you can trade a lot more frequently and more masterfully with the stock shares. But you can do it with the options. If you do choose to day trade options, become profitable on SPY first. Just day trade SPY or QQQ, something that's like massively liquid like that. Apple options are pretty liquid. Actually, I have a list right here. AMD is very liquid. Options, SPY, the VIX is quite liquid with options. You can day trade the VIX. You can day trade SPY, you can day trade QQQ, Apple, AMD, Tesla, and the sector ETF XLE. XLE just, I don't know, it trades a lot of volume. Those are 1, 2, 3, 4, 5, 6, 7 stocks that you can day trade every day, all year long, day trading to make income. And you don't even really need them all, because you can just make money on any stock all day long. It's just that maybe some of them might be kind of flat on the day, and when you get to become really advanced, you can kind of just flick around to the other ones and see if any one of them's actually making bigger moves, and you want those bigger moves, you know. All right. Anybody else got a question? What do you think about that, Aurelia? Is that going to help you feel more confident in your trades? Let's see if she's there. Maybe she's working on something. How about you, John or Sil?
Sorry, yeah. I had you on mute. Sorry, John, go ahead.
So say again, yeah, what do you think?
Oh yeah, that's good. That's good information for sure.
Excellent.
I had, yeah, for SPY, it's kind of a little too moving for me, and
Yeah,
Tesla too.
it's pretty swift.
Exactly, and Tesla. So I'm gonna,
But yeah, depending on your account size and if you can do pattern trading, you could just day trade another stock like Apple, which is only $100 per share, and you could do like a quarter of your account for day trading. That's okay, as long as you can get out at that
yeah,
stop loss. You
yeah,
can do like
yeah,
stock shares, and the reason why that might be better is because, yeah, when the things are moving so fast with SPY, you have to be like, okay, which strike do I need to pick? And you got to get, it's too much stuff to figure out, because SPY is like 300 some odd dollars per share. You have to trade the options, and you typically.
yeah. And sometimes you get confused. You want to do calls or you want to do
Oh,
puts.
I've done
Now,
that.
now
Oh,
I'm
sure.
trying to just focus on calls and just to, like, master that part and then see before I
Well,
move to puts.
yeah, well, like when you look at the whole market, which, you know, maybe you can get to the point one day where you're looking at things like this. Um, this is SPY on the daily, and then you've probably seen me posting many times about the different zones that have been going on in this drop.
Mm-hmm.
Well, you can see now we're in the bottom of zone 2. That means we have a lot of room to the upside. And in fact, if tomorrow prices break to the downside, uh, which I don't think is going to happen, but maybe that's why it could happen. But if it does happen, it also has a huge amount of room to fall. So you can kind of like look at a chart like that, you see, and say, okay, we've got this zone here where it had like a lot of topping there and a lot of bottoming there. So that created that zone, and we're back in it. We're at like the edge of it. Think of it as like different levels of a building, and we're at the floor of it. If it breaks through the floor, it's going to be at the top of a room. It's going to fall. It's going to has a lot of room to fall down. Right now, we're at the bottom of the floor. We're like, we just got up here and we have a lot of room to go up. But we're coming off of 3 candles, which in total break out of this red candle. So in the daily analysis, that's a lot of bullish movement. So you can pretty much, probability-wise, you can pretty much expect this to go up. We pretty much think this is going to go up. And as a matter of fact, in after hours, it looks very, very promising. Here's the SPY in after hours. It went way up to 335 from 334, just beautifully controlled trending, no hype that could be dumped later, just actual agreement on price movement, beautiful, smooth, controlled movement. That's what you want to see. So tomorrow, I imagine that's going to continue quite nicely and fluidly. And then I actually think it's probably going to take off and maybe fill up half of that range. That's why today at market close, being able to see all this with my magic crystal mind, I bought a bunch of shit. I bought FedEx, I bought TMO. I don't even really know what that company does, but I read charts and I see that looks really tasty. And what else did I buy? I bought a bunch of things. And so if I'm right, tomorrow I could do quite well, but they're actually swing trades. So if tomorrow goes well, I'm going to keep them on and be analyzing their charts and seeing if there's any weaknesses or if I can keep them going, and I can get multiple days out of that. And like I just taught you, I can be raising my stop loss based on what's going on in the candlesticks, so that I don't lose too much money. And if it does lose money, again, remember like what I said, you're not really losing money because it's part of the profit making process to lose. So you have to lose some to win a lot. I mean, that's just risk taking in general. So if losing is part of profit taking, then losing really is part of winning. But when you actually lose money is when you lose more than when you were supposed to get out. That's now you're losing. Now you're losing money. Yes?
Question about the choppiness. What is your experience with the election? Of course, you've been trading quite a while and have experienced elections during trading. So we're in an election
Actually,
year.
during the last election,
How does
I
how
wasn't
does that
actively
influence
trading.
it?
But here's my thoughts on that. So I think that that the market may have done what it did today because everyone knows the debates are coming tomorrow night, and everyone wants to wait and see what the outcome, who's going to mess up the most, what's the outcome of that going to be? Is it going to be kind of undecided? Is it going to be a total knockout by one of the candidates? And I think we want to see that, or is another candidate going to, fumble? Both of these candidates have weaknesses and strengths that can hurt them, and it's going to be very interesting. I think that debate is going to be one of the most important debates for the stock market, certainly. For many decades. It's going to be quite an interesting result after debate is done. I don't know when the debate starts and when it is done. I'll have to check on that. But if any of it happens during market hours, I mean, you might see the market like really flipping out. But certainly the next morning, you're going to see the results of it's pretty obvious that if Trump succeeds in the debates, if Trump's like, I think in order for Trump to be seen by everyone as the person who did better in the debates, you'd have to have both Trump do well and Biden falter, so that people who are watching Biden also go like, So you'd have to have a double. You'd have to have Trump do extremely well and Biden falter. That would be a full bullish direction for the market the next day. And then the opposite would be Biden does really well and Trump, is kind of like maybe atypically extra crude or says some things that are a little bit off color and it doesn't sit well even with Trump supporters is what I'm trying to say. It's like,
Mhm.
so it could go the other way. And in those cases, I think you would see the market not do well because if Biden gets in, there's going to be a lot more like taxes and those kinds of things. You might see cannabis stocks go up and solar go up, but the things that drive industrial innovation and like missions to Mars and stuff like that, maybe not so much, because it takes a lot of what's the word? Not entrepreneurship, but industrialness, and that's not something that like the left typically supports too much. So, and the market has an industrial side which is quite big, but it's not fully that way. Like Google is not technically kind of like not industrial. So certain stocks will do well if Biden wins the debate, if you want to call it wins, and certain stocks will do well if Trump wins. But I think the market on whole will do better if Trump wins, and on whole, on average, and worse if Biden wins that debate. Then the same thing applies with the election. Same kind of, whoever gets elected in that case. In fact, that might be a great way to gauge what the potential market like directions could be in the election results is how the market responds to the debates tomorrow night, but only in the case of a clear winner, Otherwise, you can't get a lot of information out of it. But if there's a clear winner and the market responds the next day, whatever, then you can go correlation. And then you can say, okay, well, that's what it's going to be like if Biden gets in, or that's what it's going to be like if Trump gets in. So therefore, I'm going all in on whatever, and I'm taking everything off whatever. And I'm sure I'm not the only one who thought of that. So I think there's going to be millions of investors moving their money, flowing their money in a different way later this week. So you might see just some weird stuff go on. Like if Biden wins, a lot of tech might win, a lot of like virtual tech, might win, like Zoom and stuff like that, which doesn't rely on like industrialization. But if Trump wins, you might see Tesla pop and like Workhorse and like all these like they're building like huge machines where they need a labor force and like they need better, lower prices and less taxes to be able to create more profit and to be able to put back into like industrializing and growing this industrial. So that's the machine. That's what's the word I was trying to find is I've almost got it. That's economics.
So we missed out on Workhorse.
Yeah,
The
well,
second round. I know.
probably at a certain
Remember, we're looking at it to enter when it went down. I totally missed it. And when I saw it, I'm like, oh my God, I already jumped to 28.
Yeah, entry probably should have been around 25, but I guess I was getting greedy and I wanted it down to like 23.
Yeah, you said you're at 19, 21. And
Was it?
yeah,
Then we totally missed it because I would have
yeah,
definitely got it under 20. I think it was just because all hell broke loose on the markets that day and
yeah.
I was just cutting things and the market closed and that's that. Sometimes that's the way it goes. You literally miss it. Put that up. Yeah, 20. Yeah, I would have. See, I would think I was waiting for it to kind of like
I think
press.
we're waiting for it to go lower,
I was
right?
waiting for it to press into these 4 candles, these two and these two, and get like where maybe 20. It never did. So I would definitely have sent out an alert if it hit 20, and if I wasn't like in a full-on like sell off, get your money off the market mode that day, I might have noticed and said, hey, now that we're pushing down into the top of 2 candles that were previous resistances, that will probably be support now. We probably should get a position around 20.6, and look at that. That would have been brilliant if I had seen that because that was in fact the low. And
Yeah.
But hey, did you know that on Friday I did get 4 Workhorse contracts? I just got lottery ticket ones. Like it'd have to go to 40 by the end of the week for me to even make money. But the reason
Oh,
Yeah, but the
okay.
reason why I did that is because I'm going to keep doing that every week. I'm going to keep buying those. They're really cheap. I think it was like 25 bucks because it was like $5 per contract. Really cheap. Lottery tickets are really cheap. But the point is that if they were to get awarded the contract, I keep thinking in my fundamental analysis that the stock will go to about 110. But if it goes to 60, I'll be happy. But if it does go to 110 and I have four contracts and it goes up 70 points, that's like a lot of money. I can't even do the math. I think it's like $28,000 or something.
Okay, so stop right there. So, so lottery tickets, so that means you bought calls
Yeah, I bought
at
calls that will,
way out of the money.
no, what? Out of the money. Is that what you said?
Out of, yeah, was it out of, was it in the money or out of the money?
Yeah, lottery tickets are always out of the money, and for
Okay.
them to be lottery tickets, they also have to be like just cheap and like really out of the money and just expendable money. Like, all right, tonight
Okay.
I'm gonna make dinner at home because I spent $15 buying three lottery ticket contracts today. Cheap. They're pretty cheap. They can
Mm-hmm.
they can be 25 bucks, $10, $5, $15. When you go out of the money enough, I think if I went to like 50 strike on Workhorse instead of $10 a contract, which might have been what I paid, they might have been $5 a contract. But I felt like, hey, I can spend another $5, and by having this strike lower, uh, maybe even this week, who knows? Maybe this week it goes above 40, and I actually can make some money even if they don't get awarded the contract. So I don't know. I picked a little bit lower, and yet
Mm-hmm.
there's still lottery contracts,
Yeah. Okay. Good.
lotto contract, lotto tickets. But yeah, I intend to do that pretty much every week. On Friday, I'm gonna buy workhorse lotto calls every week for the next, whenever until the news is
When are
that
we
they
expecting the news?
what again?
When are we expecting the news? Do you know?
Well,
I
I mean,
heard it was
it could,
this
it could
week,
be all
so.
the way to Christmas, but
Oh.
today Trump was like out on the lawn driving one of their cars, I think, test driving it for the post office, deal.
Mm-hmm. Yeah,
That's
that's why it jumped so high and
Yeah.
then it dropped again.
Yeah, but it wasn't really that high. I mean, you would think if he was doing that, everyone would have said, "See, they're going to get the contract," and it would have gone, like a penny stock to like 50. Uh,
Mm-hmm.
but it didn't. So I actually thought that was a little odd. So you might have thought it went up a lot, but I was surprised at how little it went up
Oh, okay.
on that news because I mean, you see these penny stocks, how
Yeah,
the
yeah, the way they jump. Yeah.
hype drives the hell out of things. Or look at Nikola when it came out, and that's not too long
Mhm.
ago, and it's a very similar stock and company. Woo! I mean, it just really took off. So I didn't see that today. So I didn't think it was a very
Hmm.
good indication for the future of the stock. I'm not sure why it didn't really rally.
Mm-hmm.
But you know what?
Mm-hmm.
Maybe it will tomorrow. Maybe it just takes overnight for everybody to get the news. You know,
Yeah.
like there's
Yeah.
going to be YouTubers and Seeking Alpha articles out like all through the night tonight about how Trump drove the Workhorse thing on the White House lawn. You guys, this is going to happen any day. That's a really bullish sign. Whatever. The hype engine is probably going to start happening.
Mm-hmm.
So, but it's
Okay.
probably not going to pay for my lotto tickets. If Workhorse doesn't go above 40 by Friday expiration, I lose my money. But I only spent like $25, so that's
Mm-hmm. Per
okay. That's no problem.
contract or for all
I
five?
think it was like $5 a contract. I think I bought like,
Oh, okay. Yeah. Mm.
or maybe it was $25 a contract because I bought four, and I think I might have spent $100. So I think
Okay.
it was $25 a contract. You might be right. Yeah.
Mm.
All right. Sil says, so when trading options, we are still looking at stock price and candlesticks. Yeah. Yes. That's how I do it. You can pull up a contract before I continue with your question. Just let me go into that. You can pull up a contract. Let's like pull up Workhorse, 2009. Nope, those are past the 1009. Oh, two they even have. That'll be really liquid calls um, at the current price of like 28. Do we have a 28? 28. Yeah, 28.5, not 28. Yeah. So you can pull up the graph for options. And this is the daily chart on options, on that option. It opened, it's not clearly indicated here where the different day dividers are. Monday, there we go. The purple line in TOS, at least, in Thinkorswim, is what the price should be, theoretically based on calculations. And then the actual charted price is where trades happened. And this purple price can actually change even when you're scrolling on the chart. I don't know why that is, but it can help you in any event. Oh no, it didn't change, but it can change in real time, I guess. It's always trying to be accurate to the current price, but the further back you go, it's less and less meaningful historically. But it can tell you, like right now, this option should sell for $1. It shows here at the close $1.70 in the purple, and yet people paid $1.75. So, but that might be because this went down, and maybe at that moment it was purple right there. But yeah, so you can look at options charts as well, but that's not going to give you any idea of how the stock is doing because the option's going to be much less liquid, so you're not going to get a clearer picture. But sure enough, we'll go take a look at Workhorse right now. Sure enough, the Workhorse chart's going to look like this too. Take a look at that, kind of memorize it. Started low, it ramped up, had like 3 spikes, went down, did a little midday slow trending, went down, and kind of like did a rounded last 2 or 3 hours there. Now let's go to Workhorse, same time frame, much more liquid, and let's zoom up to that. And you can see that exact same chart, but it's not an option now that's moving with the price of the stock. It's the actual stock, and it's so liquid that every candle is really, really well represented. There's no gaps because there was moments where nobody took a trade, or the bid and the ask was so wide because it's so low volume that, like, you know, it moved without trading, and then a new price came up and there's like holes everywhere and little dots and stuff. That would mean that it's a very illiquid stock, and you can see that with the options chart that I was just showing you, but this one's fully filled in because it's quite liquid. So your question was, I recall from your last class that we should look for delta 0.75 and high volume. However, how do we choose the strike price for it and the date? Sil, I'm going to need you to clarify that a little bit, and this is what I want to know. In what situation? Is that for swing trades or is that for day trading? Swing trades. Okay, thanks. So for swing trades, oh, wait a minute, the strike? Oh, if it's 0, the delta brings you to the strike. I do not need to specify the strike if I give you the delta. The delta matches with the strike. So if I tell you buy the 0.75 delta on Apple 2 weeks out, then now you know which option to buy and which strike, because well, I'll pull up the option chain so you can see that, but it might be very tiny on your screen. Oh, I don't think you can see the screen. Oh, I know another place we can grab it. You go over here to trade all products. Okay, it's going to be like a really wide columns and stuff. Yeah, see, sorry about that, but that is the way it is. So here's AMD, for example. When I say 2 weeks out, if I'm giving an alert or something, or anybody says get an option 2 weeks out, it doesn't mean get the weekly option that's the second weekly option out. It doesn't mean that. 2 weeks out, if somebody says at least 2 weeks out, it means at least 14 days out. And if you look at that second weekly option, it's only got 11 days left before it expires. So you're going to get screwed based on whatever recommendation you received, or your idea that you had of getting at least 2 weeks of duration, because you're only going to get 11 days of duration. So if someone says get at least 2 weeks of duration, you know, you need to be getting this one, which says 18 days left, the October 16. I don't know if you can see that very well, by the way, hopefully. Um, okay, and then when you look at the delta, it's right there. It automatically chooses the strike. There it is, 75. So we're talking about the 74.45 strike. Every strike is accompanied by a delta. It's not random. At the money strike, which, you know, this stock AMD is at 79.48, so almost 80. So you consider that kind of like the at the money strike. Oh, actually, it has a 79.50 option. That's like basically dead on at the money. At the money strikes have a 50 delta. So you can see here it says 54. That's probably because it moved up in after hours or something. But the closing price, 79.48, is would correctly show the delta there on that strike as being 0.50. If I told you to buy a option at 0.50 delta, 50-cent delta, or what I just say 50 delta, anyone who, well, most people know, people who know options well would know that means at the money, because at the money strikes are always 0.50 delta. When I tell you to get the 75 strike, I know that that's roughly about 15% in the money. So it turns out to be, but that depends on the duration also. It gets deeper and deeper and deeper, the 75 delta, depending on the expiration that you get. So it keeps getting deeper and deeper in the money in the strike.
Question.
Okay. Yeah.
So you know how I have an AMD.
Oh, you do have AMD?
I actually do, but my problem is I've actually recognized it with other options I take. Normally, if I'm trying to break even, when the stock price goes to the, let's say the price that I bought it at, I'm still not breaking even. So why is it that? Is it because of am I getting closer to the expiration date? So for instance, I bought AMD at 70, I think when it dropped to 76-ish last week, right?
Okay.
But on my option now it's close to 90. I mean close to 80. So I should have been making a little bit, but I'm not. I'm still actually under.
Okay.
So I haven't broken even, although it's past the stock price that I bought. So why does that happen?
So you bought AMD when the price of the stock was, let's just say, about 74.
Yeah.
And okay. And when you did that, which option did you buy? A 75 delta option? Because if you did, that would have been
Yeah,
about.
it was 0.75. Yeah. I always buy in like 0.75 delta.
Yeah. So then that was probably like the 67.5 strike, I'm guessing.
I can pull it up here, but
Yeah. Go ahead and pull it up. Let's just figure this out for a second.
why is
And I'll tell you what's going on.
you've taken up my screen?
4 points. 4.74 is gonna be 70, 70.5, 70. I bet you bought the 70. I'm thinking you.
Yeah, I think I bought 70. Yeah, I
Yeah, look
think
at
so.
that. It's beautifully liquid, like very liquid. Good choice. Very well done. That's a very good one that you got
Yeah,
there.
but still, I'm not. Well, I'm kind of like a dollar under, and
Okay,
every
but let's
time
take.
it,
Okay,
it
but let's
tries
look at
to.
it. All right.
Yeah,
So, and then which expiration was it?
October 16th.
Okay, so cool. We're looking right at it, and it was the 70 option, and let's see. You bought that at 74. Oh, and now it's more like 5. So when you paid for it, was it like 375 bucks?
It was. Oh, where? Sorry,
No,
yours.
it would have been 675.
Yes, that's what it was. Let me just give me 1 second here. So
Okay.
when I bought it,
Sorry, Sil, we'll get to it.
AMD, I actually bought it for no, I bought it for 1,000. So I got the 70 for October 16th.
No,
Yeah, so it was 1,000, 1,000 and a bit.
no, I don't think so because that's the current price.
That's the no, but then my average price is 10 point. So I got it for
Well, maybe
10.
you bought two contracts and they were each 500, but that doesn't make
No, I
sense.
bought one contract. It's only 10. Yeah, I got one contract for 10.50, 18.
But that's what that contract is at right now.
Now it closed at 10.33.
Yeah, that's right. Yeah.
Yeah, but well, because now it went past closer to $80, right? But what I'm saying is
Yeah.
I should have gotten like I bought this when it was 76. So
Okay.
shouldn't it have reached I just reached 10.33. I should have reached 10 point like it should have been 12. I don't understand why it's not like
Right now it should be $1,230, something like that. If you
but
paid
it
a thousand for it, but you didn't pay a thousand for it. At that time, you would have paid. Well, I mean, it depends on maybe you're not giving me the right information, but
no, yeah.
um,
It shows my
what date did you
unless
buy it on?
I what date did I buy it on? I don't
Yeah.
remember, but yeah, whatever I buy, it tells me how much I bought it. Unless maybe I chose when I bought it, I chose the ask price.
But no, because it was very liquid, and the spread on that is only about 20 cents, which is great, or 15 cents, which is great, 25 cents. So no, that wouldn't have been it.
Yeah, it's October 16, yeah,
Yeah, but
strike
when did you buy it?
70.
Can you check when you bought it? Because then I'll go to that day. Maybe there was a spike or something. I mean, I don't understand why that is.
I don't know. I can't tell when I bought it though.
Is it what app did you use? What program?
Oh, I'm using Interactive Broker.
Okay, wow, you should, yeah, you shouldn't have got anything but a good fill. So it doesn't make sense.
Yeah, anyway. Yeah, so I have actually for the whole past 2 weeks I've been under, even though because I realize whenever it goes to 78, it gets sold off right away.
Well, you might
So
have been under, yeah, the last 2 weeks, but
yeah,
what
so
can you figure out?
now,
Can you figure out when you bought it? Because I'll pull up the chart. Let's take a look.
yeah, how can I, let me see.
Check your, well, I don't know. Does it, maybe it
Uh,
might show you the transaction history on it.
yeah, I'm gonna see if I can find transaction history.
I'm gonna pull up the yearly chart here. Oh, it's for, did you say AMD? And while you're doing that, I'm just gonna try and finish helping Sil.
Yeah, sure.
I think I did actually. So what do you think, Sil? Do you think I answered that? I don't think I left anything out of there as far as like, the delta is what, kind of winds up specifying the strike. And if the instructions were like to say get 2 weeks or 2 months or 14 or more days or whatever, then you should get at least that amount of time. Sorry, brushing teeth. Okay, yeah, great. Okay, good. All right, now I pulled up AMD, and depending on when you bought it, so like the price today might have been the price when you bought it.
You're talking to me?
Yeah,
Yeah, I think so.
because
Oh,
look at this.
no, no, no. It was, oh, mm-mm.
What
What
date did
is
you
the
buy it?
price? 79. Let me go look at their chat. Maybe I remember.
Okay.
I'm still learning with that interactive broker, but I
IBKR,
think
yeah.
I bought it when it had the first drop. It was 76-ish. I
John, let me
remember.
know if you have any questions. You can just type them in the chat, and I'd be happy to answer them while Aurelia's looking for anything. Or Sil, if you have any other questions about trade management, money management, anything really, I'll do the best I can to try and help.
I think I got it September 14th.
Okay, September 14, the highest price of that day was 78.8, which is only 60 cents away from where you are now, and the lowest point that day was 76.29, which is like, all right, so now you say you paid 1,000 that day. Oh, look at the, oh, I know what's going on. I know what's
Okay.
going on.
What is
Uh,
going on?
Look at, there's earnings were released on September 18th. So that was
So,
before, like when you bought the option,
mm-hmm,
earnings were, I forget what you said, September 13 or 14. Earnings were 4 days away.
mm-hmm.
And now earnings have been 5 days happened. And so whenever earnings happen, I don't know, was that earnings? No, that might not be true. This might be,
Because that was the beginning of the crash, like, when everything went down kind of thing, and then coming back up again.
yeah, no, that's not the problem. No, I mean, my thing that I was talking about earnings. No, the earnings were not then. The earnings were on July 28th. I was thinking that it was volatility crush. I was thinking that some kind of hype was going on, and that made the options contracts a little bit more expensive. So what you bought might have should have been, like I said, like $750, but maybe
Mm-hmm.
because there was a lot of hyped up things going on, could have been news, whatever, a lot of demand came in, and that puffs up the volatility. It could have been $1,000 like you paid. And so that's part of options as well, is the volatility aspect. And
Mm-hmm.
that's going to be a dynamic that is going to be really hard to start to manage, because that's like a whole nother dimension of looking at things. However, yeah, you could almost say that because price was coming down and you bought at a low, that when it went up, see, when prices go up, volatility goes down. Like, the VIX,
Mm-hmm.
when the stock market goes up, the VIX goes down, right?
Yeah.
So the VIX is volatility measurement, by the way, of all options. It's like the combined. It's quite a sophisticated measurement, but it's like pretty much the combined volatility of all options. And uh, so you can see by that when prices go up, volatility goes down. And if you had bought when prices were going down, volatility went up, right? That makes sense, okay? Like using the VIX example.
Yeah, I see.
So that means if you had bought when prices were coming down violently, you probably got a little puffed up extra. The pricing on the options might have been a little puffed up.
Mm.
And that's a really good, a really great point. Hopefully, the few people who are maybe the few people who will watch this or who are watching now can learn a lesson there, which is that it's much better for you to buy something that's been going up for it to go up, because you're probably already getting it at whatever the lowest volatility level is, because it's already got that angle going. But if it's going down, and you get in, and it goes up, you also have to compensate for the fact that the volatility changed a little bit. So anyway, right now you are at break even, which is good. And if the price were to violently go down, I guess you'd get a little extra padding by the volatility going up, but you don't want that. But tomorrow, hopefully, fingers crossed, the prices go up, and you've got the October 16th expiration, and you can start to use that technique that I just mentioned earlier for getting stopped out eventually on this. And from
Yeah.
and from what I see, things look good, because if the next candle goes above this 20 period SMA,
Mm.
and if it's strong, which it could be, tomorrow could be a strong day, but maybe not, because people are waiting for the Biden thing. But if it's strong, it'll turn that 20 period SMA upward. And that'll mean that you got in before a big move. Because once that starts to go upward, this stock's going to make a rally. It's going to make a move. Like here, when when the yellow 20 period SMA started to curve up, uh, you can see the stock really started to go, and that could be just about to happen on AMD. That could be pretty tasty for your return. If
I
it,
hope so. I hope so. I nearly sold it today, but I was like, you know what? I have 2 weeks left.
yeah,
So,
no, oh gosh, I'm glad you didn't, because continuation is quite inevitable tomorrow.
yeah.
But
Yeah.
nothing's
Because
inevitable.
again, you never know. Today is good, tomorrow is bad, everything is crashing, and you're like, you've lost.
It's so tough to play all these. to think of all these parameters. But from the way I see it, as like a stock doctor, looking at the chart, looking at your chart,
Mm-hmm.
the way I see it, it has full potential, depending on the market, to go all the way to, easily to test 86.
Mm.
Because it's got enough momentum. These three candles are good, and I don't see why it couldn't go as far as it just went, which was from 73 to 79 to basically 80, so 7 points. I
Mm.
kind of don't see why it couldn't go from there another like 5, 6, 7 points, so like 85, 86. What was I going to say about that? Oh, but just make sure that you try to
Mm-hmm.
apply some of that little stop loss rules that I said
Yeah.
from here
Yeah.
on out, because at least you'll be part of a profitable system with rules that you can rely on in the long run, will become profitable, and you're not just winging it and getting it out at whatever happens. And
Mm-hmm.
and actually hopefully it turns into the point where you're actually out for a real tasty profit. I think you could end up making like $500 on it minimum,
Yeah.
and then
Yeah.
maybe if you get lucky, you might make like 800 to 1,000. So that's almost double your money.
Hopefully, we'll see. Whatever. I hope. I just wanted to clear away from the 10.30 area and enter into 12.
Yeah, we figured it out. So I think that's what it
Yeah.
was.
Yeah. Yeah.
Volatility. Yeah, the price of
Yeah.
when things drop, volatility goes up, but when they start to go up, volatility goes down. And it looks like it affected the price of your option about 20% because it should be worth about 1,200 bucks. It's only worth 1,000.
Yeah. Yeah.
20%. So
Yeah.
it sounds like a little bit, but yeah, it really affected the outcome a little bit. But it'll catch up too, by the way. You'll see that like the volatility is also going like this. It's also wavering. So even as the price goes up, volatility is kind of like a moving average also. It will start to kind of like average out as well, and you're going to get a if the price keeps going like it is. Oh, if it does a little pullback, maybe on
Mm-hmm.
Wednesday or maybe tomorrow, but it doesn't stop you out, that will help the volatility kind of return to the previous levels on
Mm.
the next day. Like it'll go down a little maybe tomorrow. We don't think so, but maybe it could. Uh,
Mm.
that will increase the volatility, and then the next day, Wednesday, if the price goes up, it will carry some of that recent increased volatility, even with the price increase, which would be great because you're going to get price increase and a little bit more volatility. But you'll be saved by price increase, that's for sure.
Yeah, for sure. That's what I want.
Yes, price increase. Oh, Sil says he was looking at the option. He says right now the volatility is 180%. And then he was talking about volume and open interest. But I don't know what it was when you bought it. But if it was 20% more, which we think it was, then it probably was 216% volatility.
Mm.
And so this is another dimension of options that one of the reasons why I like to have people buy deep in the money at that 75 delta is you don't get affected so much on your purchase by volatility. Had you bought at the money, whoo, the price difference now
Mm-hmm.
would
Mm-hmm.
have been much more just
Mm.
the volatility difference. But
Mm.
also because the delta was lower, that would have sucked too. Is buying 75 delta or better, you can sometimes if the closest strike is 0.80 with a lot of liquidity, like if that's the most liquid one, go for that one too. Basically, if you can buy an option that's at 1 delta, which is kind of next to impossible, so you might get like 0.93. Um, it's almost like buying the stock at that point. It's just so there's no premium at all, and it's just rock hard stock, and it will behave like stock, and it won't get affected by volatility, and it won't get affected by
Mm.
theta, and it will just.
But of course, that is more expensive.
But it's more expensive. But so is the stock. If you bought 100 shares of the stock,
Yeah,
it'd be 3 times even more expensive than that. So it's still
true.
cheaper,
Yeah.
but it is more.
Okay, I'm gonna run.
Huh?
I'm gonna run.
Okay, see you later.
Yeah. Yeah. Thank you so much. I'll see you
Okay,
tomorrow.
see
Yeah.
you. All right.
Okay then.
Good luck
Bye.
tomorrow.
Yeah.
Sil, you say I bought a SPAC call, $20 strike, 10/16 expiration. This is before I had learned about Delta from you. Okay, let's take a look at that. John, if you got a question, just type it in there or let me know. Hopefully you're digging it. Let's see. So, what date did you buy it? Okay, bought it on 9/23. All right, let's get in here. So, first thing I want to say is this is a fucking shit stock. Cause look at this thing. It's like, there's so much speculation and gamble on this compared to like what I was talking about. And I know you said directly right there that this was before you learned about anything from me. But I just want to I want you to see if you've learned that as well. Like, can you see that this is nothing reliable? Like, this is a gamble. Like, can you see, not just because of that huge spike where it started, because we know that's when the SPAC became public or decided what it was going to buy, so it gave it some value. Not because of that, but kind of like even after that, it's just quite all over the place, right? It's not that bad. I mean, it's got a bowl, it's got like a cup, but it sure doesn't look like anything like a reliable, trend that you can go with, which is the kind of stocks you want to be picking, especially for swing trading. What you're doing here, by the way, when you buy something on as what you would call a swing trade on a stock like this with the intention of hoping it does whatever big like explosive news move or hype move or whatnot, that's not a swing trade. You might think it's a swing trade, but that's not a swing trade, because swing trades were born from trading something called a channel. So if we go to Amazon, over to London, we'll come back to that SPAC and I'll get you your analysis. But if you look at Amazon, you can see that overall, I'm going to get a line. I wish I could just draw. I think you can draw with annotation tools right on this. Let's see. Annotate. Cool. Let me do that. So draw a line. All right, let's see if it works. I don't think it's going to work. Oh, it worked. All right, so you can see, I didn't draw very good. But there's kind of an upper channel going on there, right? It's very hard for me to draw that, but all right. Swing trading, what it is, and let me get that annotation off. Okay, good. Is actually, annotation stuff is pretty nice. Let me get like an arrow or something. Does it have that? Draw? It does. All right. Liking it. Let's use something that's a color that's not on there. Yeah, hot pink. So swing trading is when you take the low of a channel and you sell at the high. And then you take the low of the channel and you sell at the high of the channel. And this is a channel. It's a reliable channel. You can roughly get your entry and your exit every time if you know how to watch price action and say, okay, that seems to be the end of the move. Then every time you're getting that, you probably would sell there, and then it pulled back towards that line again, and you go here. And that's swing trading. Swing trading is taking a position in something that's like a swing between a low and a high, that's consistent and predictable, and you get in and you get out and you make your money, and it's a living. So let's go back to, let me get that off of there. How do we do that? Clear all drawings. Cool. Were you able to see that drawing stuff there, you guys? It kind of gave me a notice that maybe made me think you weren't able to see that. Yes, good. All right, so let's pull up SPAC again. And I just want you to know that this is not a swing trade. Why is it not typing? My keyboard's not working. What? Oh, that was weird. Okay, must have something to do with that. This is not a swing trade. This is a full-on gamble. This is a casino spin. trying to get your color, it's it's speculation, it's full speculation. And yeah, SPACs, the deals happen, and then you go kind of pre-IPO, and you're probably, might be able to get like 40 bucks of it. But you don't know when. You don't know if your investment money or your trade money or your position is going to get hammered for half a year or how long it's going to take, So just FYI, just remember that there's a massive difference between making money trading and speculating on bullshit penny stocks and SPACs and stuff like that. But that's why everybody does it. It's okay. That's why I get lotto tickets to do it. Like I don't know if you can buy options on this SPAC, but oh yeah, you said you did, right? Yes, you did. But it might be better served by buying like a way long out, like a couple lottery tickets. They're not going to be that cheap because of the time, but it might be the same price that you just paid, and you might therefore get a lot more duration. And besides, this play is a total gamble anyway, because you don't know when it's going to happen. So anyway, maybe you are swing trading it still. I don't know. Maybe you found like some pattern here, and you found the low, and you're buying low, and you're going to sell high. Maybe, and that is a swing trade. Okay, so maybe that's what you're going after. And now when we're analyzing this, I'm seeing that maybe is what you did. So let's take a look at that. So on September 23rd, which was right here. No, damn, I wish you did buy that. But you did buy somewhere in here on September 23rd, which is still semi-good. I mean, it's only semi-good because it went lower, but you wouldn't have known that day. I mean, as far as I'm concerned, you did a really good job buying on the 23rd of September, because for all intents and purposes, that was a really great, dip to get in on. All right. So on something that has hype, SPACs are popular and all that. So in that sense, yeah, I could see how this is a swing trade, but hopefully you see the difference I was kind of trying to illustrate there. So you bought it for $1.32. The 10-16 strike, which is going to expire there. That's what that little dotted red line is. And I guess you're wondering, let's see, what's the question? Should you keep it or drop it? Let's check the pricing now. What's it at now? And you got the, which strike? 20 strike. 20 strike. Oh, you did buy lotto tickets. You bought out of the money. Oh, okay, all right. So now it's 75 cents. So it's less than what you bought it. But if you had bought like iInstruct, which was the 75 delta, I know you said it was before that, you would have bought like the 12.5 or maybe even the 10. It would have cost more, but you would be losing money over time. That's the difference. So what's happening now is you're losing $5 a day, and that's going to accelerate just in time. Oh, I'm sorry, it's even worse than that. Yeah, well, actually it says 5, but it's probably even worse than that. So soon that money will be dwindled into nothing unless the price starts to approach or get in or cross 20. So because of what you bought, the real question is, A, how soon could you get more money back than $75? And B, could you ever get your original capital back of $128, $132? And C, could you ever even get more than that? All right, so let's look at the chart. And here's how you can figure that out. So we'll draw a line. On September 23rd, somewhere in this bar, I'm going to guess right in the middle, the volume weighted average price. I'm just going to guess in the middle, 15 bucks-ish. Maybe you bought it there. Did you buy it lower, Sal? Do you remember when you bought it, like what price the stock was at that point? Was it like 15 bucks? Yeah, you don't. Okay, let's just guess it was, 15 bucks. All right, so what you did is you bought there, and this is something you can do. You can draw lines. And You bought the 20. Shit, it's even so bad. It's out of view. All right, I'm going to show you how bad this looks, man. Prognosis is not wonderful. All right. Okay. Go like this and get up to about there. You spent $1.32, you said? $1.32? Yeah, $1.32. All right. Okay. So when you buy the 20 strike for $1.32, that means by expiration it better be $21.32, the stock price, or you're losing money by expiration. By expiration, okay? That doesn't mean during it. By expiration. So let's draw that line. The trajectory you have to beat with the price of the stock from the point of purchase to the break-even price that gives you your money back by the time expiration happens, $21.32, is right there. Okay? So anytime the stock price does not go over that line, you are not getting your money back. Okay? So that doesn't look too good, man. Right? If this stock would have to go through the roof and you still wouldn't get your money back. Do you see that? Can you imagine that? The stock price needs to surpass this white line for you to get your money back. That's how fucked out of the money options are. I really hope you understand that. You know, like, yeah. No, it's not an expensive lesson. It was only 132 bucks. I'll give you an expensive lesson to learn sometime. That was a cheap lesson to learn. You can make that in one day at a day job somewhere. That was a cheap lesson to learn. So, but you can sell tomorrow for 70 bucks probably, and you'll have lost 60 bucks. And so that's how much you lost. I mean, that's like 4 hours of work at minimum wage. That's not that bad. So it's a cheap lesson learned. But hey, you never know. I mean, check the action tomorrow. Just to see how bullish, how strong, how crazy the price is going. If it's going strong, let it do its thing. But if it starts to pull back, use those techniques that I taught. Maybe you saw the Thursday class that I taught, which will tell you if the trend is kind of reversing. I think that was in a Tuesday or a Monday class. But you can see the trend reversing. So on the day, on the 1 minute chart, you'll be able to spot kind of where the top is and where it's petering out and where, you know, you're near the top. You know, get out over there. Don't try to hang on and say, oh, maybe it'll go higher. When it looks like it's not going higher anymore, here's a good example. If you get during the day, let's see if I can find one so I can show you. I'm going to go to the 1 minute chart. When I say during the day, I'm talking about looking at the 1 minute chart. During the day, if you get a extremely long, strong red candle, guaranteed, man, the stock is not going to be going up after that. Today was a bad day, for example, because it was a sideways trend. Let me check the previous day for a more accurate example of that. So near the opening bell here, the stock price, see, that's not like a real strong red candle, but that's pretty strong, 3 red candles in a row. I would have gone out like right there. But yeah, sure enough, the price did go up later in the day. So you can just double check, are you moving above the 200? Are you above VWAP? You know, if you're above the 200 and you're above VWAP, it could trend all day, you know, so long as it stays above both of those, you know, approximately. It kind of didn't here. It freaked out. And if you were watching it that minute, you would have been like, oh crap, and you probably would have sold. So, you know, you can't get these things perfect. But, you know, tomorrow if you're watching and things do go in your direction and it just works out, you know, use the best of your ability to get out at near a top. And you can tell if it's a top only once it's reversed down and broken some of the other, you know, bullish candles. When a strongly bullish candle is taken out, that's bad. You know, it means the strong bullishness didn't even matter. It was overtaken by even stronger bearishness, you know, as they call it. So, yeah, you got to kind of like watch the price action tomorrow to see if it goes in that direction. And and after all that said, therefore you might be able to sell for $95, maybe $105. But if not, it could go to 65 or 60. Yeah, and then you're down to $75. I guess in proportion to your account, yeah, it's an expensive lesson. I know, but you could probably get that money back pretty fast. So that's the difference between like the $32,000 loss I took on Friday on Amazon on one option contract and a $75 loss that you're going to maybe have to take tomorrow. Is that it could take me not as a day trader, but it could take a normal person an entire year to earn that back. And that means that's an expensive loss in my mind. That's how I think of it. All right, guys, I think that unless you came up with a question, or Sil, if you have another question, please ask it. But if not, then we'll end right there. What do you guys think? All set? Good? All right. Good night, guys. See you tomorrow.
Good night.
Good night.